So let's talk about the buyer's dilemma. So the buyer's dilemma and finding the true business value is really where we are. So picture this, Mike, he claims his business makes 900,000 in profit. Uh, you come across Mike's listing and you say, okay, it fits my business buy box. Um, a potential buyer needs to carefully understand what is what is Mike's personal spending and what are the actual costs required to run the business. So if the business Adbacks are showing things like owner expenses, etc., Mike, you need to understand through conversations with Mike, are these necessary to operate the business, or is there something, potentially that's non-operating? Are these personal expenses, like his car or travel? Um, but do those expenses not actually correlate to revenues? Um, this is sort of the buyer's dilemma, and a lot of the challenges you face as a buyer is understanding business versus non-business expenses. Because while the business may claim 900,000 in profit, that may include 500,000 of business expenses that are added back. So basically, if Mike says, "Oh, these are owner operated, the business doesn't need to spend this money to produce the revenues," that's sort of the buyer's dilemma. It's finding that true business value. So how do we do that? It, I like to think of it as a four-prong, value-driven approach. It starts with kind of the core value. So this adjusts the profit for the certain add backs. If we want to move on to the next slide, it's the four stages of it is the core value. It adjusts the profit for add backs. Um, it then moves into owner expenses. So it identifies personal costs in the books, um, things like automobiles, charitable contributions, maybe the owner's salary, maybe the owner's family member salary, etc. And then it looks to validate the add backs. So are these valid or not? So are we going to keep the non-recurring items? Are these recurring items that are necessary? And then ultimately it shows us an adjusted earnings, which is the true cash flow we use for valuation. So what is an add back? Some add backs, things like irregular expenses, costs that don't follow a consistent pattern and vary significantly over time. For example, if the company had a one-time large marketing expense for $50,000, which was an ad campaign, for example, on the radio, maybe they put up a few billboards in 1 month to drive sales. Um, those are an example of irregular expenses. Now the question is, should these expenses be added back? Um, and you can make a case for both. The case for not including them is that these expenses, while they are irregular, do relate to business, real business costs. Um, Real business costs in that these were, you know, an ad campaign which may have been unsuccessful, but the business still incurred these costs. So this is the challenge and something you want to pay attention to. Um, Ambitious owners, sellers, and brokers will look to add back as much as possible. When it comes to irregular expenses or non-recurring costs or costs that they deem are not true business costs. Um, the challenge with those are they made decisions for the business, but now they are looking to get credit and say they are non-business costs. So for another example would be um, one-time expenses such as cleaning up the books of the financial statements in order to prepare for sale. These are non-recurring costs, maybe one time that the company needed in order to get the company positioned for sale. Costs like that are what I deem transaction expenses and valid add-backs. Discretionary spending. Discretionary spending is add backs like travel, personal costs that the business burden the P&L. And when I say burden, I mean they expense the P&L in order to reduce taxable income or use the business as a personal fund. This is very common in small businesses and something you need to be careful of when you're looking at these add backs. So again, recapping, three categories of add backs, which you'll see are irregular expenses, costs that vary significantly month to month, non-recurring expenses, which are one time, and then discretionary spending. Discretionary expenses such as travel, automobiles, one time, large family vacations, etc. Uh, Understanding and determining what certain categories are falling in is really the crux of how to do an add back analysis appropriately. So, why do they matter? Why do add backs matter for buyers? And then putting yourself in the shoes of the seller, why do they matter for sellers? So, most of this audience is typically prospective business buyers, but for buyers, these add backs matter because you want to understand what are the true operational costs of the business. You want to remove uncertainty about how much, how many expenses, or from a dollars and cents standpoint, what are the dollars and costs in order to run this business? And it helps you confidently assess what are the future costs of this business going forward. So, for example, if the business is showing $1 million of revenue on an annual basis and $500,000 of total expenses, you can reasonably assess that the business um, needs about $41,000 per month in order to, those are the costs of the business, which is pretty favorable. It's about a 50% gross margin. The challenge is, are those $500,000 of expenses all operational in nature, or are some of these personal owner discretionary that they're using in order to reduce taxable income, etc.? Uh, the challenge, and this is for sellers, they'll make the case of uh, they need add backs because it shows a higher and true value of their business. So they may be recording personal owner expenses on the QuickBooks or the accounting system in the expenses of their business, but they may use the excuse of, oh, we do it for tax reasons. We are doing it because we want to reduce taxable income. My CPA said that was okay. They will use all these excuses to explain their way of why certain non-business expenses appeared in their QuickBooks financial statements. More often than not, they use the the tax strategies uh, as the reason for a lot of these expenses making it into the P&L. The challenge is they want to take credit for these expenses not being business related and increasing their value of their business while also taking advantage of the tax benefits, by reducing their net income. This is sort of the challenge where buyers and sellers need to meet in the middle. So by understanding why sellers are using add backs, you can better understand things to look out for and better ways to negotiate, some of these add backs. And really, this is sort of the crux of M&A and deal making. So it's definitely important to understand both sides of the table and really what you're trying to accomplish from, doing this add back analysis. As I go through and work through the presentation, I'll pause about in the middle to answer a few questions. I saw a few come in right now. If you want to keep putting them in, I'll get to them, in a timely manner. So again, double clicking on some of the types of add backs. Again, we have non-operating, which is expenses that are not required for the operations of the business. So some examples include vehicle expenses, which could be personal in nature, uh, discretionary expenses that do not add to the operating performance of the company. So examples of that could be um, travel fees, entertainment for the owner and the owner's family, uh, if they were going to professional sports events, things that don't drive top line sales are discretionary owner expenses. Non-recurring expenses can be tricky. So, non-recurring expenses are unlikely they will occur again in the future. So, what does that look like for a small business, specifically like a small business acquisition? These things could be technology upgrades, relocation expenses, transaction related costs to clean up the business before sale. In terms of uh, the most tricky ones, which when you're doing an add back analysis, maybe you may be conflicted, is the ones that are non-recurring are the trickiest to assess if these are valid add backs or invalid. Things like travel expenses and very clear owner benefit costs that the business is incurring on behalf of the owner, those are easy to understand. Um, what falls into the gray area of add backs and is really this non-recurring. So making sure you fairly assess whether or not these should be valid add backs is a challenge, which will be, you can use a CPA or your buy side team to assess if these should be valid add backs or invalidated. So, what are some commonly accepted add backs? So, these are legitimate add backs, which are non-recurring, properly documented, and unnecessary for ongoing operations, post-transaction or post-sale. So if you want to take a screenshot of this, these are some of my commonly accepted add backs, which, in my opinion, um, should be valid and can be supported with documentation. The reason why I say properly documented is when you're going through underwriting and you are looking to show the business earnings higher than what is presented on a tax return. For example, if the business tax return shows net incomes of $1 million, of net income, if you want to add back or increase the earnings of the company by 200,000 based on some of these add backs, you are trying to get a loan out for a business with net incomes of 1.2 million. So from a bank standpoint, in order for them to give you credit for these add backs, they need to confirm that they're legitimate. So this is the crux of what, a QOV provider will do. For those of you who just stumbled on my channel for the first time, I lead a small QOV practice of M&A CPA accountants, which specifically focus on small to medium-sized business acquisitions. So this is what we do for a living. Properly documenting and legitimizing these add backs for bank underwriting is the crux of what we do. So if we want to go back, the one-time expenses can be things like legal settlements. Legal settlements. So these are, um, depending on the type of business, if the company received a legal settlement for a claim, for example, if a ex-employee left the company and they shared some private secrets, if they sued that employee and received a legal settlement, that those amounts. could be credited as income, and inflated on earnings if they weren't recorded. On the flip side, if the company paid $50,000 for a legal settlement fee from a customer, or if they were sued by another company, those expenses, if truly one-time in nature, could be considered, you know, a acceptable expense add back. So again, to talk about legal, because this does come up because these are significant dollars. If I owned a business and I was sued for, um, you know, poor service or, um, you know, a market compete or, stealing secrets, and I had to pay an attorney $25,000 to represent us for this one-time legal lawsuit. Those expenses, in my opinion, should be added back because uh, if this was really a one-off thing for the company, uh, while it dragged down the net income of the business, it truly is one time, and these expenses should be added back because it's not expected to be incurred going forward. Another one which comes up a lot is the idea around owner compensation and family payroll, or people, related to the owner, which are on the payroll but are not contributing to the business. So let's unpack that for a second because owner compensation and payroll for family owner, relatives comes up a lot. So a lot of times in practice, here's what I see. Um, the owner may be heavily involved in the day-to-day operations of the business, but the owner's wife, who, let's say, for example, is receiving a $100,000 salary uh, on the business, which the business is properly paying payroll taxes, um, and paying the owner's wife $100,000 every 2 weeks in line with the payroll cycle throughout the year. If it turns out that the owner's wife actually doesn't have a role with the business, they're not a bookkeeper, they're not involved with the business at all. Um, those are examples where the company is reducing earnings for an individual which is not business related. So the question I get all the time is this allowed by tax? Is the IRS going to be okay with this, etc.? The challenge is when you're assessing a business from the financial standpoint, whether or not the company is doing things the right way for tax reasons is not applicable. That's a whole separate issue when it comes to add back analysis. So the challenge many first-time buyers and folks who are not, CPAs or accounting centric, they will struggle to separate the legality of what they're doing compared to the reality. That's what I always say. From a strictly financial due diligence standpoint, the goal is to assess what are the true business earnings of the company. It's not to assess whether or not they're paying taxes correctly. That is a separate bucket. This discussion is strictly for financial due diligence. In the example of the wife, if she is not business related and she's being paid $100,000 by the company, if it's determined through discussions with management she has no role in the business, her entire salary should be added back um, as a EBITDA lift. So you're increasing the earnings of the business of her wage. Closing out this example, if the owner's family has, if he has a son and daughter also on payroll and they're not involved with the business and they are simply there to reduce taxable income, um, that is a tax strategy they're using, but these amounts should all be added back to the earnings of the company. The last example is if it turns out these owners are heavily involved in the business. So let's say the owner is the sales, technically, he brings in all the sales of the business, and the wife is the bookkeeper, manages payroll, and she's also, a quasi general manager. Those expenses can be added back, but what you need to do is you need to ask yourself a question of what is their replacement cost? What sort of folks do I need to hire to replace them going forward? The replacement salaries should be, you can use benchmarks for the location the business is in, and those amounts should be reduced from EBITDA or the net incomes of the business. So giving you a simple example, if the total family payroll was $100,000, but you needed to hire one individual for $80,000 to replace them, the total impact would only be a $20,000 add back to the net incomes of the company. So this idea of family add backs also needs to be offset by the replacement cost of these individuals. So when you're assessing replacement costs, I would use benchmarks and research, online. I'm sure there's industry specific metrics you can point uh, to show legitimate offsets to the business. Typically, especially in small business acquisitions, um, brokers and sell side representatives will use SDE. Unfortunately, with SDE, seller discretionary earnings, they are adding back all wages, but they don't consider the replacement costs of these individuals. So be on the lookout for these sort of, marketing materials and SDE numbers. If those SDE numbers are showing folks who are critical to the business, who will not be involved going forward post transaction closing, you almost always should throw in a benchmark of at least 50 or $100,000 of a replacement cost in order to find new people who will be doing those jobs when you assume duties going forward. So this is something that comes up a lot. Um, so my point of advice, if you are actively searching for a business, looking to buy a business, but you're not under contract, considering that replacement cost should be something you do really before you even have these discussions. If you have questions around that, I'm happy to answer them. Um, Benchmarking costs such as, bookkeeper, general manager can be kind of tricky. I like to be I like to be conservative when I'm thinking about these. So that's just food for thought of that topic. Getting to a couple questions. We spoke on how do you treat where the owner is employing his wife and son in the business. I would learn their roles and duties and assess whether they're related to the business or not. If they need to be replaced, just benchmarking those replacement costs. So some of the best practices for add back success, and this is best practices to conduct an add back analysis, is to use a conservative approach. You'll see here that uh, aggressive non-GAAP add backs increase your loan default risk. If you are very aggressive when it comes to add backs, you're showing the business can earn higher than it in reality will. This can lead to an increase in default rate. You need to be conservative in your adjustments and maintain, confidence to ensure deal completion. The challenge is if you do get away with some of these add backs and you are able to secure a higher loan amount, it's good news and bad news. The good news is you may be able to buy a larger business. The bad news is the business may not be able to support those monthly debt services, which now you are responsible for a larger loan. So in general, my advice is to be conservative about these add backs because in the end, it only increases your default risk. And remember, add backs should reveal true earning potential and not inflate it. Credible adjustments build trust. Aggressive adbacks can be very challenging to get a loan, and it often can destroy your deal. So be careful, especially if you're a buyer trying to add back a bunch of things which are, really business related. It's very likely a bank is not going to approve all these add backs. So just be conservative when you're thinking about these things. So we kind of touched on these best practices, but documenting your add backs is really the key to pass underwriting. When you're going through a bank underwriting, even through an SBA bank, they are going to comb through your ad backs, look for support and legitimacy around these. So if you're able to provide them with legitimate ad back support, it'll make your life a lot easier. If you're not comfortable getting these ad backs, gathering the support and really rolling up your sleeves, leverage a QOV provider or, a financial due diligence CPA firm to help you with this documentation. It'll make your lives a lot easier during underwriting. I've gone through the underwriting process hundreds of times. The most, with proper documentation, it makes underwriting significantly less challenging because you're able to clearly articulate what are some of the ad backs you're looking to get credit for, why they are legitimate, and then it can be supported uh, directly with the support you provide. So it's kind of like the three-prong approach in order to get these ad backs approved during underwriting. So, why do owner ad backs matter in deal analysis? Yeah, it looks to drive valuation. So ad backs directly impact the purchase price multiple of a typical business transaction. So without getting too caught in the weeds of this, since we did hammer on this, the more ad backs you are able to validate and get into the business, it may impact actually how much you pay for it. So we'll flip to an example in the sake of time, but this is going to show you, a good idea of what are some of these ad backs, why do they matter? So let me flip to my screen and we'll walk through some of them. So, so okay, so what you should be seeing is a snapshot of what are owner ad backs in a real live deal. So this is a recent deal. Um, you'll see that when I speak about the ad back section, this can be shown on, right here. So we kind of touched upon some of these. We call them due diligence adjustments, but in reality, these are the add backs of the company. So the company is reporting EBITDA, you can also use the word SDE if that's what you're familiar with, of 1.4 million in the trailing 12 months. In order to get a higher valuation or a larger loan amount, after our analysis, we identified 733,000 of owner costs, as well as things like other income. The other income was related to a legal settlement, other expenses, and then we removed income, interest income and expense. So if we double click on the owner related costs, the reason why you'll see such a large add back is This business was seven entities, each run by one member of their family. So each member of their family was no longer going to be with the company following transaction closing. So after discussions with the management team, who was looking to buy the company in this independent sponsor deal, um, they were going to implement their own operators. It was about three operators who were going to run these seven entities for about 300, $386,000. So this $386,000 will offset this $700,000 amount. So when we think about these add backs, if we go back to our example, um, we effectively are propping up earnings by $733,000 because these owners or these family members are no longer going to be with the company. And then we are offsetting this EBITDA by the expected 300K. So in reality, the business is earning about 1.4 million EBITDA or SDE on a reported basis based on some cost saving initiatives. This company's earnings is closer to 2 million. You'll see on the screen it says 2.3. This is not considering that $300,000 of those other add backs. So that's just one example of, ways to look through expenses. If we flip to the next slide, we'll kind of walk through what some of these other expenses look like. So here is um, here is another example of this same very deal. If we zoom in, you will see that here's an example of some owner related costs. So this comes up a lot. So the owner related cost has things like owner insurance, auto expenses, gifts and donations, as well as meals and entertainment. So if we think about what types of ad backs are these, and what kind of categories do they fall in? The auto expenses, uh, gifts and donations, and the meals and entertainment. These fall in the owner personal discretionary expenses. The auto expenses was the owner had a few vehicles that the business was paying for, but it was not going to be there post-transaction closing. Um, the business owner had $63,000 of meals and entertainment. It was a few family vacations as well as meals that were truly non-business related that the business paid for on behalf of the owner and his family. Um, Through detailed review of the line by line transactions, I determined that those were non-business and entirely personal. So therefore, in my opinion, those should be added back to the business expenses, the business earnings. Um, Gifts and donations, this is another one where I classify it as it's a gray area in an add back analysis. So these gifts and donations, of the 30,000 or 31,000 you see on the screen, the total gifts and donations were about 50,000 in the last 12 months of the business. The extra 20,000 were gifts and donations the owner gave to employees. But these were really annual bonuses that each employee would be entitled to. So if we think about discretionary versus true business expenses, these would fall into business expenses, which actually are not valid add backs. They're not valid because um, a new owner, like if you yourself are a new owner, you're not all of a sudden going to get rid of all the bonuses for the employees that have received them for the last 30 years. You very well could, but from a banking standpoint, They're going to assume you're going to keep things, business as usual. So you're not going to get credit for doing an aggressive add back in that manner. So if we flip over to the cost saving, because this had a question that came up. So this cost saving was a pro forma adjustment. Um, so specifically, depending on the nature of it, if we were to flip through, it must have been an expense line item that was going to be implemented going forward. I think this cost saving was going to be a consolidation of the business systems, if I recall correctly. Therefore, the business had, since it was seven entities, they each were using their own accounting system, et cetera, or other, CRM systems. So they were going to consolidate this under one roof, and therefore the expenses were going to be reduced by 300,000. Very good question. If it was an adjustment that, would be, it would be therefore a deduct.